Hello, I'm Haider Malik, host of the MEMI Financial Group podcast. Today's topic is acquiring competitors' acquisition financing for Edmonton trucking companies. Buying a rival carrier can turbocharge growth, add strategic lanes, and secure assets, but you need the right funding mix to close efficiently and preserve cash flow. Here's how to structure acquisition financing in the Edmonton market. 1. Define your acquisition plan. Target profile. Identify competitors with complementary routes, oilfield shuttles, northern hauls, or regional LTL services, and sound equipment fleets. Deal structure. Decide on an asset purchase, trucks, trailers, contracts, versus stock purchase, entire company, including liabilities. 2. Financing components. 1. Senior term loan. Covers 50 to 70% of the purchase price. Amortized over 5 to 7 years with fixed or floating rates near prime plus 1%. Lenders evaluate combined pro forma cash flows and EBITDA of both firms. 2. Second lien or mezzanine debt. Bridges the gap between senior debt and equity, 10-20% of deal. Higher interest, prime plus 3 to 5% and shorter term, 3 to 5 years. Often includes payment in kind interest or warrants. 3. Equity injection. Founders, managements, or private equity backing, 20 to 30% of purchase price. Demonstrates skin in the game, improving lender confidence. 4. Seller notes. Deferred payments to the seller, 5 to 15% of price, tied to post-close performance or retention of key contracts. Aligns incentives and reduces upfront cash needs. 3. Valuation and due diligence. Fleet appraisal. Obtain independent valuations on trucks and trailers, factoring in Edmonton's harsh winters and mileage. Contract review. Audit existing customer agreements for duration, margin, and renewal likelihood, particularly oilfield or municipal routes. Operational assessment. Analyze maintenance records, driver retention, and safety scores to anticipate integration costs. 4. Lender selection. Local banks and credit unions. ATB Financial and Service Credit Union understand Alberta's market cycles and may offer relationship-driven rates. Specialty transportation lenders. Firms focused on trucking acquisitions can underwrite complex structures with seller notes and mezzanine layers. Private equity or family offices. For larger roll-up strategies, consider co-investment to boost equity and negotiation leverage. 5. Structuring the financing package. Debt service coverage. Model pro forma cash flows combining both companies. Aim for a minimum 1.25x coverage ratio on senior debt. Covenant light versus covenant heavy. Negotiate flexible covenants, interest coverage, leverage ratios aligned to seasonal swings in Edmonton hauling. Integration reserve. Carve out 5-10% of deal value into escrow for post-close integration, driver bonuses, or capital repairs. 6. Execution timeline. 1. Letter of intent, LOI. Secure exclusivity and outline deal terms. Purchase price, structure, due diligence, scope. 2. Due diligence, 30 to 45 days. Finalize fleet appraisals, contract audits, and financial reviews. 3. Commitment letter. Obtain lender term sheets committing financing at negotiated spreads. 4. Closing 60-90 days. Execute purchase agreement, financing documents, and fund sources, then begin integration. 7. Post-acquisition integration. Systems and processes. Align dispatch, billing, and maintenance schedules. Culture and retention. Offer retention bonuses or equity to key drivers and managers. Cost synergies. Combine fuel contracts, insurance, and back office functions to realize 5 to 10% expense savings. Key takeaway. Acquiring a competitor in Edmonton's trucking sector demands a blended financing strategy: senior loans for scale, mezzanine or seller notes for flexibility, and equity to secure favorable terms. By valuing assets accurately, choosing the right lenders, and structuring covenants and reserves thoughtfully, you'll close deals efficiently and drive long-term growth. I'm Haider Malik. Thanks for listening, and here's to smart acquisitions that power your fleet's future.